expected. Well, jobs data today has showed us that the pace of U.S. job losses has eased, but the unemployment rate jumped to 9.7%, which is the highest since June of 1983. Joining us now to help us dig deeper into these numbers is Roger Kubarych, Senior Fellow at the U.S. Council on Foreign Relations. Roger, it is great to see you. Nice to have you here. What's your take on the jobs report so far? Most of the people we've spoken to have called it a mixed picture.
I would call them humbling numbers. The job market still is lousy. It's not really improving. It's just not deteriorating as fast as it did last fall and winter after Lehman's failure. And there's really not a lot of strength across the board. There's a number at the back of the report. Nobody follows it, but it's just as important as the ISM surveys, which you do follow.
Why is that? Well, first of all, what's this one you're getting to?
See, what it does is it tells you roughly the proportion of companies, industries that are raising employment versus those that are reducing employment, and the overall number is around 30. Now, if the ISM were around 30, the headlines would be awful, awful, awful economy. And certainly that's what it blares out today. And the number is actually under 30 for manufacturing, which means there may be some strength, but it's very localized in terms of just a few industries in which jobs are going up. But most companies in most industries are still cutting employment.
Private sector jobs did increase, right? Or at least are showing signs of a bottom.
Yeah,
Kathleen Hayes pointed to that as one positive note.
Well, things are bottoming. There's no doubt about that. But the most important number is the weekly unemployment claims. They're still running at 570,000 every week, times 4.5 weeks. Well over, really close to 2.5 million people are being laid off. Before people start being hard, you've got to look for businesses to stop laying people off. That's the true leading indicator in this. Unemployment rate, I think, used to be a lagging indicator. Now it's contemporaneous. It really shows that there's aggressive, I would say ruthless job cutting still by businesses because they're getting away with it. They're actually being able to maintain their output, meeting demand, fewer people. It's going to be a long time before they think they need new staff.
Would you characterize the labor market, though, as at a bottom? We don't know yet how long this bottom
is
tread here.
It's still bottoming. I think the GDP has bottomed. And you'll see, and probably industrial production has bottomed.
And then we talk about this lag between economic recovery, overall recovery versus labor market recovery.
Yeah, as a business, you have to feel pinched. You have to feel that you can't really meet customers' demands before you go back in and hire people. And you see that every month in a report that gets no attention because it comes out with a lag. It's called the JOLTS report, Job Openings and Labor Turnover Survey. Job openings are down to 2.5 million. A year and a half ago, they were nearly 4 million. So there are fewer and fewer businesses posting openings, and voluntary quits, which Alan Greenspan used to really like that number, because that shows people's confidence. If you can leave a job voluntarily, it's because you think you can get a better one. That's down nearly 1 million from its peak. So people are really staying in their current job. They're still anxious.
And you're not even talking about federal stimulus fading out now, too. So this has to add to your outlook.
I mean, you had Christina Romer, and I've seen her at the Council on Foreign Relations, and she says over and over again, if this thing stalls out, we will do another stimulus. And the governors want it. State and local government finances are shambles. Many of them are technically bankrupt. What California did was virtually a technical bankruptcy with these kind of IOUs. And they need another stimulus because a lot of the stimulus is actually offsetting, sort of giving them resources to pay their workers.
Is that what the labor market needs, this kind of federal infusion, another one?
Well, I don't know.
What is the solution?
Well, I don't know. We're not going to see a big increase in the car industry. There'll be a little cyclical lift, but we'll stay around 10 million, 11 million, 12 million. We used to sell 17 million. So that industry won't come back. Businesses already overinvested in high tech. Exports are shaky. So we got to have infrastructure investment to be a substitute, and then state and local governments don't have the financial wherewithal to do that. So I think that this recovery process is going to be fits and starts. I'd characterize it as a running W, one little W after another, for several years. There'll be a couple of quarters of good performance, and then a couple of quarters where things stall out or go backwards until we can really recalibrate. Consumption's going to be less of a factor, business investment is going to be iffy, and you really need the infrastructure, and just drive on some highways in New York and you'll know that.
Gosh, we're really in a pickle.
Well, we're in a pickle. And we got into a pickle because of excessive spending off of the backs of a housing boom. And the policymakers didn't come to grips with that soon enough.
Do you think we finally learned our lesson about bubbles, whether it be technology, housing, credit?
No, I don't think so. There'll be another bubble very shortly. And probably in the stock market and in some parts of the commodity markets. There's so much cheap money around that people will say, well, gee, how can you go wrong? You get zero on the bank. You might as well take a little bit of a risk. How wrong can you go? So good companies with dividends are going to run up very, very strongly, and commodity prices are bound to go up as the world economy improves.
Do you think the stock market right now is fair valued?
No, I think that there is no such thing as fair valued. I think it's whatever the marginal investor wants to do. And right now, with near zero Fed funds rate, the stock market's got a lot of room for bubbling.
All right. So then what should the Federal Reserve do then to prevent that bubble?
Well, watchful waiting and keep talking a tough line that as soon as inflation reappears, we will act.
So it hasn't exhausted all of its resources?
Well, I mean, they can keep on buying mortgage-backed securities till the cows come home. And you need to help housing, because without a lift in housing prices, and that takes a much stronger than housing market than just bottoming, that the Fed can be very helpful there.
All right. Roger Kubarych, thank you so much for your time and your insights.
And glad to be with you.
Roger Kubarych is the Senior Fellow of the U.S. Council on Foreign Relations, joining us today.